So let me jump into the loan. What is it? At its core, what the all-in-one loan is a line of credit. That's a very important factor. Yes, it's technically a mortgage, but unlike traditional mortgages that are closed-ended or one-way instruments, lines of credit are spectacular because they're very flexible. They're two-way instruments or open-ended instruments. And that provides a lot of flexibility and payment options that borrowers really demand today. But this line of credit is also structured very differently than traditional lines of credit that you are probably familiar with already or have had on your own home in the past. Starting with the fact that the draw timing on this, the access to home equity dollars lasts for 30 years on this home equity line of credit. That's unlike any other line of credit that I know of on the market today. Additionally, this one takes first lien position, and that's also very important. We want to get rid of the archaic fixed rate or conventionally designed mortgage product on the home, because that represents part of the problem that consumers have today, and I'll describe that problem here in a moment. But this removes that by paying it off, and it takes first lien position on the house. Additionally, there is no balloon payment or any forced payment requirement throughout the entire loan. There's payment options throughout the entire loan term for 360 months. You could pay interest only, you could pay more towards principal, you could in fact allow it to pay the interest on its own for you and not actually put anything into it because maybe you need those resources for something else that month. It allows all of that and has no balloon payment requirement. So structurally speaking, this line of credit is really, kind of a line of credit on steroids, if you will. But what makes it even better is that this line of credit is also structured with a checking account embedded in it. In other words, this is borrowing and banking in one account. So home finance and personal banking in one singular account, complete with ATM cards and checks, secured online banking and bill pay, mobile banking. It's a full feature, fraud protected, fully transactional bank account that comes within your mortgage. Now let me cover why that actually makes sense. Starting with checking accounts. Checking accounts are a very important instrument. We all use them. They're very powerful. This is where most of us that are working and can qualify for a mortgage and a house these days leverage our income. Most of our income dollars flow through our personal checking account. Very powerful vehicle. We like the idea that we have access to those dollars, and prior to needing or spending those dollars, our income is secure and it's accessible through all the features, right? Think about for a moment, if you were to total up the amount of money that you personally have deposited through your own personal checking account over the course of the last 10 years. For the average American, it's actually a great sum of money. It's probably more than you owe on your house. You might think of your checking account or your income as your largest asset in life. There is no greater resource to you throughout your lifetime than the income that you earn. And that's what makes a checking account or short-term savings account so powerful, because these are the tools that we use to manage those dollars prior to needing to spend them. Conversely, we spend a ton of interest costs or interest dollars on a mortgage instrument while we earn very little on our checking account cash, right? Our checking accounts pay us very little while our mortgage costs us significantly more in interest. For most Americans with a mortgage, it represents their largest personal expense. And there's this imaginary line or this imaginary wall or barrier between these two accounts here in the United States. Not in other countries, but here in the United States, the banking paradigm and the banking system keeps these two accounts separate. Now, the mortgage is a barrier. It's a barrier not because of the interest rate, not because most of our borrowers that have a mortgage today don't have a historically low fixed rate on their mortgage. That's not the problem. The problem is how that mortgage is actually structured, how it's designed. And I'm talking specifically about how payments are applied to the instrument. We know these instruments come with part principal and part interest, but we also know that Right from the get-go, right from the start, our payments are applied to interest primarily first. It actually takes a little over a decade, closer to 15 years, on it when we borrow on a 30-year fixed mortgage, to get to a point to where the payment itself is about 50-50 interest and principal, right? These loans were designed during the Great Depression era in the 1930s, and they were designed to make your monthly payment more affordable by way of offsetting or delaying the actual pay down of the debt itself, right? We may on the phone here today all have differences in opinion on a variety of things, but the one thing that we can agree on is that the longer you remain in debt, the costlier that debt becomes to you. It's just that simple, even with a low interest rate. Let me repeat that. The longer you remain in debt, the costlier that debt is to you, even with a low interest rate. And it's just a matter of math. So let's break down that math very briefly by comparing a conventional 30-year fixed mortgage with a conventional 15-year fixed mortgage, both at the exact same loan amount. But that 30-year fixed mortgage has a 4% interest rate, and that 15-year fixed mortgage comes with an interest rate that is nearly double that of the other loan. If you were interested, discounting payment, right? Discounting the payment amount. If you were solely interested in saving time and saving money, which product would provide that for you? Obviously, this is a loaded question. That 15-year fixed 7% loan would be the better choice. It would save the customer a little over $30,000 in interest and 15 years of their life of paying on a mortgage. But go beyond that. Think about the other thing that you get by getting rid of a debt faster. You actually gain an opportunity to go build wealth and go fund some other financial obligations that are important to you. So it saves you money, it saves you time, and creates opportunity to go do other more important things with your money than paying a mortgage. So it's just a matter of math. Interest rate matters least is the point of this slide, is my point here. Interest rate matters least. What matters most is, financially speaking, is just reduction of principal and getting out of debt faster, right? Accelerating the pay down of your debt. It has many, many benefits to the consumer. Now, the problem with a 15-year fixed mortgage and is reflective in what we know about how many people actually have a 15-year fixed mortgage. Only about 7%, 8% of American borrowers with a mortgage have a 15-year fixed mortgage. About 86% have a 30-year fixed. The problem with a 15-year fix is that that payment is higher, right? And even if it's affordable or comfortable, many customers, many borrowers don't like to just lock away those extra funds, right, when they don't have to. They like the idea of it. They understand the logic and the math behind it, and financially how that would benefit them. But many consumers don't do it because they just don't want to, submit those dollars and have them locked up in their mortgage and not have access to those funds. And that's exactly what the all-in-one loan and its design solve. It solves that problem. By combining personal banking with the line of credit, with the mortgage itself, a borrower is able to actually leverage their personal income, their resources, any receivables, any idle dollars that you have today and will have tomorrow, you just haven't spent yet, towards your mortgage balance, towards your principal balance. And that helps reduce it faster. And it helps you avoid monthly interest payments and annually save potentially thousands, and over time, tens of thousands of dollars in mortgage interest is completely avoided. It's just an avoidance of mortgage interest. And the loan comes complete with all the access features you're accustomed to with a regular checking account. POS ATM cards backed by Visa, ATM access, there's no fees for usage. If an outside bank charges a fee for pulling out money out of an ATM machine, or by swiping the card and using it as an ATM card, those can be reimbursed by our service providers. Personal checks are issued by request, and there's no limit to how much can be deposited or written in checks. And of course, online banking and mobile banking and bill pay, all through your mortgage. So we've taken an archaic instrument, right, that keeps your loan balance higher for longer, which equates into more mortgage interest costs. And we've completely redesigned it and essentially changed the way payments are applied to the mortgage itself. And in the all-in-one's case, payments are applied to principal first. If you want to strike up a conversation and raise some curiosity and some interest in what you do and about the all-in-one loan and create a conversation pretty rapidly, you can do it that way. You can open a door pretty rapidly by saying, I offer a loan that pays principal first, because the loan you likely have pays interest primarily first. That not only costs you excessive amounts of your own resources, but it slows you down through time. It does. It's an impediment towards other goals like retirement savings and other things. By making payments towards principal first on this loan through a series of deposits and withdrawals, you're able to reduce the principal faster and avoid a ton of interest cost. And the result of that is having your home paid off faster. Whether that's a goal or not, that's just what happens. So let me go into how it actually works on a daily basis, starting with really day one, and I'll use $300,000 as a starting principal balance. When you make a deposit into the all-in-one loan, right, we've refinanced the customer out of their 30-year fixed mortgage, and they might have had a really low rate and a nice, comfortable, affordable payment, but we've refinanced them out of that, paid that off, got them the all-in-one loan, and within about 3 weeks of closing, they received the checking account features and a welcome kit, welcome letter, their temporary passwords and stuff for their online banking and bill pay. They can get this checking account that's attached to their mortgage set up, and they can start leveraging their income and their idle money that may be sitting there already in their savings account or checking account. Every deposit is applied immediately to principal that day. So in this example, if a borrower were to make a $10,000 deposit, what actually occurs is at midnight, that deposit is swept. It's swept out of the checking account side of the account, and it pays down the principal balance of the HELOC automatically. It does that for the customer. You can literally wake up the next day and you see the principal balance is lower by the exact same amount that was deposited in the prior day. So the new principal balance would be $290,000. What you've actually done here is you've taken cash that would normally sit idle in a checking account, earning no interest, and instead you deposit it into the all-in-one loan, and you've created home equity dollars, right, and that are accessible in the form of credit through the line of credit itself. And while those dollars are sitting there leveraged against your principal balance, you're now effectively saving mortgage interest at the rate of the all-in-one loan itself. So if the rate of the loan is 5% on the all-in-one loan, you're saving interest effectively at 5%. You're avoiding interest at 5% versus earning only 0 or 10 basis points on those dollars down the street at your bank account. You have full access to your funds. So when it comes to spending on your cell phone and your grocery shopping and all that stuff, little by little, as you spend money out of the account, it grows your balance. But the key here is that interest is calculated nightly. It's not amortized over time like a traditional mortgage. It's calculated according to your nightly unpaid principal balance. So in this case, that new balance of $290,000 is multiplied by the fully indexed interest rate here. In this example, I'm using 4%, divided by the number of days in the year, and that gives you your per diem interest cost. Now that's not charged daily, it's just calculated daily. In the meantime, from day 2 and all the way to the rest of the month, you're spending money out of the account. You've got other bills and expenses you got to pay throughout the month. So, but what you don't spend out of the account are really fall into 2 categories. Any residual money that you just didn't need to support your lifestyle. So you can already begin to understand that this loan is really suitable for cash flow positive homeowners. Typically not your first time home buyer that is struggling to come up with enough money for a deal called Home Fund Me. But this is a product that's designed for cash flow positive, established borrowers that are likely on not their first mortgage, but probably their second or third, maybe even their second or third home. And they tend to have typically about 10% of their disposable income left over at the end of the month, right? They're cash flow positive. So those dollars, while they sit idle, are constantly leveraged against the principal balance, and that helps compound their savings. In addition to that, the previous mortgage payment that a borrower was making, I'm using $1,432 here, which would equate into a 4% 30-year fixed at $300,000. That P&I amount that you were submitting to your previous lender no longer needs to be spent with them because we refinanced that borrower out of that loan. So those dollars also become residual, right? So with no change to spending habit, you could see that right away, just in month number 1, the borrower would have built an additional $1,932 in home equity dollars with no change in spending habit. And they've also been able to save an interest cost because of the way the interest is calculated. Now the interest cost is, or the interest payment becomes due after the month ends. And it is actually applied automatically back to the balance roughly on the 21st of each and every single month, the 20th or the 21st of every single month. And it's just assessed, it's applied, and all of that is visible to the borrower through the statements that are mailed, the online banking and bill pay portal, through our service providers, and of course the mobile banking app. You can tap right into your account and see exactly what your principal balance is, how much equity dollars you have available. You can set up the account to automatically make your gas and electric bill payments, your car payments, all the stuff that you got to do. And you see all that activity, including your interest payment due, right in the statements, right online. Meanwhile, you just continue to spend and deposit and withdraw like normal. And what happens is your principal balance continuously shrinks or reduces over time because you're compounding your savings by leveraging the money you already have. So it's kind of a set it and forget it mentality. Given this same example, running these numbers through our interactive simulator, which I'll demonstrate to you in just a moment, compared to a 30-year fixed mortgage, which is good. A 15-year fixed mortgage is a little bit better, but the all-in-one loan really accomplishes those things that those two other products can't. It provides liquidity, access to equity dollars, the security and the flexibility to use extra funds to pay down faster. For cash flow positive borrowers, this is a typical scenario, a typical example of an average borrower that would take out this loan with us. And they would save $80,000, a little over $80,000 compared to that 30-year fixed mortgage, and have their home paid off in a little over 12 years. That's a substantial amount of time and money savings that you now can offer customers out there, either that are looking for a mortgage or already have a mortgage and they just don't know that there's a smarter way to borrow.